I personally set aside kind of what I want for retirement into Vanguard, full market index funds. But then I also keep a small portfolio kind of above that to usually trade in individual biotech stocks.
If you are an individual investor, and you probably are, if you're watching this, how should you invest to get the best returns? And who's on your side and who's not? These sound like philosophical questions, but they're very, very important. The whole industry around individual investing in the US and the world writ large is filled with success stories, failure stories, people profiting at your expense, and just a lot of confusion. And here to help me unpack some of that confusion, because he's done direct research on this, unlike many academics, is Austin Moss. He is an assistant professor of accounting at the University of Colorado Boulder. And like I mentioned, he has done direct research into some of Robinhood's push notifications and the responses on individual investor behavior. So, Austin, welcome.
Hi, James. Thanks for having me. It's a great opportunity to talk with you.
Always a pleasure. And we've chatted a few times before. We were at our friend Alan's conference in the UK. I think last time we chatted. Congratulations on your marriage, by the way.
Thank you.
So let me start with a quick lightning round. No need to overthink these. Just the audience can get to know you a little bit. Last cheese that you ate?
American, white American.
American. Okay. How recently was that? Just out of curiosity.
A week and a half ago.
Okay. So not like a frequent cheese eater, just
No.
occasional cheese.
I've been trying to slim down a little bit, so cheese kind of
Yeah,
gets
cheese is surprisingly calorically dense. The saturated fat. Anyway, don't get me started on that. But okay. So personal investing style. How do you invest yourself?
So I personally set aside kind of what I want for retirement into Vanguard, full market index funds. But then I also keep a small portfolio kind of above that to usually trade in individual biotech stocks.
Biotech stocks. I would not have known that had I not asked. Interesting. Well, you can sure make a lot of money and lose too, but if your winners pay for the losers, it's worthwhile. And they're amongst the most fun biotech. I used to do biotech private equity.
Oh, cool.
And there are some fun, spicy little stocks. Okay, favorite sport, either to play or to watch?
Women's basketball currently. Caitlin Clark for the University of Iowa is really making big moves in sports overall.
Yeah, it's been amazing. Have you seen the viewership data surpassed the men and more views than most NFL games or something like that? I saw.
Yeah.
It's
All
pretty
of
pretty cool.
the championship game of the women's had more viewers than the men's championship, and it had more than all of the MLB World Series last year.
Wow. I can never watch baseball anyway. It's just so slow, I just fall asleep. It shows us the power of human psychology. As people, we like to get behind a narrative. We like a hero. We like a story. We see people rather than teams sometimes. And I think that some of those biases also carry over to investing in different ways. We definitely like stories. We react strongly to stuff that happens near us, to things that happen often, or familiarity bias. There are all sorts of interesting things that happen when we bring our human perspective, which is based on sort of Cro-Magnon evolution for a deterministic world, into the social science of investing. And this is going to dovetail with some of your research, I believe. Let's start with a broad question, which may sound obvious to some, but is actually not so obvious to academics, is should retail investors be buying individual stocks? Because we got data like Dow Jones found that over most 20-year periods, like 96%, I think it was, of long-term fund managers can't beat the S&P 500. Or Hank Bessenbinder from Arizona State University found that from 1926 to around 2020, just 4% of U.S. stocks contributed all the gains, and all the rest just collectively matched treasuries. So in other words, you got a very small sliver of stocks that are making all the money, and some other data is they're doing over a very small time period, and most even professional investors can't make money. So why should individual investors even try to buy regular stocks?
Yeah, that's a good question. And I think it goes back to some research by Hirschleifer out in California. His paper, it's looking at a pretty earlier data set, early 2000s, but of the retail investors, they're able to look at roughly 15 to 20% can persistently beat the market. A lot of things have changed since then. So
Yeah.
technology is completely different, not only from the retail investor perspective. Retail investors have a lot more access to data, free trades, things that should boost their performance. But we also have to think about the other side. Who are retail investors competing against typically? That's going to be hedge fund managers, algorithmic traders, etc. And I would say their technology boost has even been greater
Yeah.
than retail investors. I mean, these people are trading in nanoseconds, whereas for us retail investors to even process a trade, it's minutes at the very smallest, but really you should be doing a lot of research and, should be hours or days or months even into understanding your positions. And so I think that's kind of dovetails into, so we have 15 to 20% of people that a long time ago could persistently beat the market index. Now, whether retail investors should be buying individual stocks, I think depends on one, the alternative use of the funds, and two, how much you're already kind of what the rest of the portfolio looks like. So, like when my friends ask what they should be doing, I say if you put 15% of your income away into like a broad market kind of retirement index fund, then any money that you have over top of that, if you want to invest in individual stocks and believe you can beat the market, then I'm all for that.
And that's actually what I think of too, right? I mean, you buy the S&P 500 index because over time it's gone up something like 10% per year, depending on what, data set you use, but roughly that, right? Maybe, 7.5, 8% inflation adjusted, but either way, those are both really good numbers. And it wouldn't be a mistake just to hold the index, right? So you do that as a beginning, and then you would only venture into individual stocks if you thought on a risk adjusted basis you could outperform the index, or maybe if you had an income need. Let's say you wanted to draw dividends for spending purposes. That's a performance characteristic the index doesn't really give you as much as a high yield stock would.
That's exactly right. So it can depend on specific circumstances. I also think it can depend a little bit on, like we've been talking about whether, or in academics as well, typically think about whether individuals should invest in individual stocks from a pure monetary perspective. But we also have to consider this general notion of utility or entertainment value or happiness.
Mm-hmm,
And so I
mm-hmm.
think a decent amount of investors today view the stock market similarly to sports betting or to gambling.
Yep.
And so if we can actually, let's imagine we had an individual who is either going to go to the casino and spend $100 or go to the stock market and invest $100. The stock market investment is actually a much greater expected value payoff because on average it increases 7 to 8% a year. On the other hand, we know that the expected payoff over the long term of sports betting or going against these casinos, it's negative.
That's a great way to look at it. I mean, glass half full perspective. A lot of people get criticized for thinking of investing like gambling, and I think that's fair from one lens, but it's actually a lot better than actual gambling. You're in theory contributing to this capitalist system. You're ideally discriminating against bad businesses in favor of good businesses. In other words, depriving bad businesses of capital, giving it to good companies that are going to go out there and march forward human progress. In a sense, investing is betting on the progress of humanity over time, and it's been a pretty good bet so far. So maybe they're not perfect, maybe they're doing it irresponsibly, maybe they're trading too quickly and enriching too many middlemen, but it's at least better than a real casino. I mean, I guess the counter argument I would give would be, and this is more on the institutional end, all these like nanosecond traders, like if you ask them what's your benefit to humanity, and I've done this, they'll say, well, we add liquidity into the system. But I that's true. That's true. But I tend to think that's overridden by the value detraction of the volatility that they add. In other words, yes, you may be adding liquidity, but unless I'm talking about stock options, volatility is a valuation reducer.
Right.
If you can get exact $50 payout next year compared to either 25 or 75 or something in the middle, like the precision adds value compared to having a range, and
Yep.
you're taking away that precision when you add volatility into the system.
I completely agree. I think it's actually a pretty big debate, not only academically, but amongst regulators and people who are participating in the markets as to what these people's value add is, and whether I think the Congress has recently talked about like a financial transaction tax,
Hmm.
basically to try and eliminate this
Yeah, which Warren Buffett likes.
this
Yeah,
nanosecond trading.
yeah, and I think it should have it.
Yeah.
And in fact, one of my little pet projects, and I'm going to turn to your research in a second, but would be to create like a class of stock that you couldn't sell for like 2 years. Like you're locked in. You know, you day to day liquidity. I mean, it looks like a benefit, but sometimes it's a bug more than it's a feature. And the old days you'd invest for a long time as a real owner of a company. But anyway, let's enough about crazy ideas, at least from James Early. Let's focus on Austin Moss's research. So the paper entitled "How Do Brokerages Digital Engagement Practices Affect Retail Investor Information Processing and Trading" is the one I want to ask about, Austin. You got data from Robinhood for this? Am I not mistaken? Or did they
Um,
did they willing you give you data first of
so
all?
Robinhood did not give me data.
Okay,
I collected Robinhood data
I see. I was going to
um,
ask. Yeah,
from their website and other means, but there was no reciprocation on Robinhood's part.
gotcha. By the way, did they contact you about this at all, like afterwards?
They never contacted me.
So you're not anyone's like negative list that you know of. And so you looked at 5% movements up or down because those are the thresholds at which Robinhood sends you a notification. Hey, your stock was up 5%. Hey, your stock was down 5%, buddy. They have continued this practice. Robinhood did get some inquiry. In fact, a congressional hearing a couple of years ago that I would say is largely political theater, but regarding their confetti and some other kind of gewgaws, which they have since discontinued, but they have maintained this threshold notification. Can you tell us a little bit more about what you found?
Yeah. So looking at these push notifications, found that they significantly increased the amount of retail investor trading. If I compare the hour before the push notification to the hour afterwards, there's an increase of 25% in retail
Wow,
trading.
that's
And
meaningful. It's not
that is
like 0.04%. Like 25% is very meaningful.
that's right. And like to put these numbers into to put these numbers into
Mhm.
context, I estimate that this induces an extra 750,000 trades every year at minimum, um, and specifically on the Robinhood platform, which also over my sample period of 4 years comes out to about 250 million extra shares traded between
Wow.
2017 and 2020.
So that's definitely increased, and it's making Robinhood some money, I would say. I mean, it's a free trade system, but they do make money on the order flow. Well, it's not huge, so it's making them some incremental money.
Right.
How does it affect the retail investors?
That's actually an interesting finding. Is that so? After positive push notifications, retail investors are realizing their gains, so they're more likely to sell after a positive push notification. After the negative push notification, these people are buying the dip, and so they're buying after a negative push notification. And there's two things I want to say here is this evidence is consistent with like an academic behavioral theory called the disposition effect,
Hmm.
in which people are more likely to sell their winners than losers. And this is typically seen as a negative impact on
Yeah.
performance. However, in my specific setting, with these 5% push notifications, I see the opposite. So this is actually these push notifications tend to increase performance very, very slightly or have no impact. But I do not find evidence that this is harmful to these retail investors. And I want to add one quick caveat to that is that of course the data that I have is at the aggregate level. So all I
Hmm.
can see is a retail investor traded at this certain time. I do not know that this retail investor was Bob or Joanne. And so, one caveat is that these push notifications could be beneficial to a subgroup of retail investors while also being detrimental to many others. And it's just that on aggregate, after we wash those out, it seems to have little to no effect.
That's a great point. Averages and aggregates and medians, they can hide meaningful discrepancies within those broad umbrellas. So there could be a subgroup that's benefiting substantially, and there could be another group that's actually injured by this. And then, by the way, you're watching this. It's obviously I am from BBAE. We are a broker, technically competitor of Robinhood. We have no dog in this fight. I'm just talking about an interesting topic, and we don't have any notifications. We definitely have no confetti. Straightforward brokerage. Get what you expect. Nothing more, nothing less. So one question I have about the study design: if you had, so Robinhood does this daily, right? A daily movement of 5%. If you were to speculate, and I know researchers generally hate speculating, but if instead they were to do this on a yearly basis or on a 6 month, some longer term basis, let's say, hey, your thing is up 50%. Do you think the effect would be different?
So because there's less push notifications, the blown up aggregate effect would be much smaller.
Yeah.
But I would expect or speculate that an individual reacts pretty similarly to a 5% push notification on a daily
Mhm.
level as they would a 50%, over the course of a year.
Yeah, that seems fair. That seems fair. I guess the other angle that I'm thinking of, and we were just talking before we recorded about this system, somewhat induces a stat arb or a statistical arbitrage trading strategy in the sense, or one version of it. A simple stat arb strategy might be you go long the 10% of stocks, or maybe the 10 biggest losers of the day, betting that the market just overpunished them on a particular day, and then you go short the 10 biggest winners, betting the market overreacted and pumped them up too much. And it's a self-funding trade. So it's a little bit in that direction. In other words, betting that the market tends to overreact in the short term. Maybe it doesn't overreact as much in the long run. So I think you're right on the individual side. On the market side, the question would be, how overvalued or undervalued would those trades be in a long run sense? But I don't have any reason to think that they would be massively different either. I guess
That's right.
just randomly speculating.
And also, one thing to add is because I can't see people's specific portfolio trades,
Mm-hmm.
when I'm talking about performance, I'm talking about basically returns as if the retail investor held the stock or shorted the stock essentially on the sell side for 1 week, 2 week, and a month out.
Mm-hmm.
And so I'm not actually able to see with my data
Yeah.
a specific person, when they bought or
Yeah,
sold.
person by person data on the exact returns. I gotcha.
That's right.
So if we were just to blow up the whole financial system, at least in the U.S. or maybe in the developed world, and start fresh, how would you, Austin Moss, design a system that would best help individual investors to maximize their returns?
That's a really good question. Um, I think a couple things. I'm a big proponent of, as long as people have the available information, letting them choose to do whatever they want. So I wouldn't want to artificially steer people necessarily towards broad market mutual funds, at least just
Mm-hmm.
from like a morality, ethical, my
Yeah.
standpoint. But what I would want to do is make it very transparent how the investors are performing relative to the best alternative or the alternative of just investing in the a market ETF.
So
So
make them aware of how well they're doing, basically.
exactly right, and
Yeah.
I think this works. This is actually a pretty beneficial digital engagement practice, I think,
Mm-hmm.
because it can help both people doing well. So let's say you're an individual investor and you are outperforming the stock market or the market-based index with your individual trades. You can see that by comparing your performance to the market. And that presumably would encourage you to continue doing whatever you're doing to earn that performance. But for those individuals who are unable to outperform the market and are significantly underperforming the market, that group of investors would also see this comparison between them and the market. They would realize that they're losing out on all this, potential gains, and presumably that would encourage them to then instead invest in, a market ETF.
You've got a lot of faith in humanity. I hope you're right. I hope those people would realize, wow, I stink as an investor, and I should not be picking stocks. I think some would realize, and maybe some would still have an overconfidence bias. It's funny because I'm thinking of my dad, as you're saying. He's a very smart guy, and he often has very good investing ideas. His weakness is that he'll have the idea, and it's a good idea, and he should invest at that time, but he's just like not quite ready yet. And then once he finally feels comfortable after the stock has demonstrated a long period of superior performance,
Yeah.
then he jumps in, right? And then it inevitably goes down. So
The
someone
old
like
buy
him, maybe
high,
he could
sell low strategy.
exactly he could input his idea when he first feels it, and then like as a marker, and then he can go back. Oh, if I invested when I first had my hunch, I would have made a lot more money than when I actually invested. Sort of a variant of that idea. All right, so let me just bring up one other bit of research you did before we close, Austin, which is the irrelevance. I'm going to read the title here: the irrelevance of, I love this word, environmental, social, and governance disclosure to retail investors. Now, ESG has been hot, and then it's been not hot over the past 3 years. It was all the rage, and some huge percent of new ETFs were ESG related. ESG was taking over the world basically, and because there are a lot of people who truly care. I believe most people doing ESG or involved in ESG care. They want to make the world better. They want to do the right thing. As we saw after Russia invaded Ukraine, and I think it was Citigroup, and then the EU Council on Sustainable Finance, like they suddenly like flipped around. They used to hate guns. They used to hate defense, but wait a minute, when guns are used to defend us, they're good,
That's right.
so suddenly they did a flip flop. Same thing with oil and renewable energies, right? I mean, I'm fine if you hate oil stocks as long as you don't drive a car. It just, the economics is just a little more complicated than all these do-gooders realize. And I say this as someone who loves ESG himself too. I wish it can work. What did you find in this paper?
I mean, the basic takeaway is that retail investors are not responding or reacting to these ESG press releases. That's the takeaway of the whole paper. We kind of defend, or we not defend, but we also look at other press releases that they might be reacting to, basically to rule out, like, is it just the fact that they're not reacting to any press releases, or is this something specific to ESG related? And so we look at other economic factor based press releases, such as earnings releases, etc. We find that they do react to those types of kind of meaningful economic activity press releases, but not the ESG press release.
Specifically ignoring the ESG.
That's right.
Like the pretty girl who answers other people's calls, but just not your call, just not reacting to ESG.
That's right.
And what was the time?
One quick thing is that it actually came up, it's cited in the recent SEC climate rules.
Oh, wow.
So it's
Congratulations.
been talked about, at this policy level of, do we need these disclosures? Are people going to use these climate related disclosures? Our paper says, for a specific subset of market participants, it doesn't seem like they really care that much about some of these additional disclosures.
Yeah, that makes sense. And what was the time period that you looked at?
So there we looked 2017 through 2018. So it was about a 2-year period.
Okay.
And it was really when ESG, I would say, was hot.
Yeah.
Kind of before this anti-ESG.
So if anything, it's probably gotten worse since then. Yeah, interesting finding. And I'm glad we have academic researchers like you doing this kind of research, because it's how we learn about things. And often there's a huge difference between the marketing people who have an incentive, like Charlie Munger says, you show me the incentive, I'll show you the behavior. Works that way in investing too. So it's good to have people who are unbiased, or at least less biased, and have a different set of incentives. So thanks for doing that.
Yeah, thank you.
So someone says, Austin Moss, I like what you're saying. I want more of it. Where would you send that person? How can they follow you?
Yeah, so I publish all my research at austinmoss.me, which is my website.
Just .me. Yep.
.me.
Okay.
And then I'm also getting more active on Twitter with just pretty simplified summaries of some of the research that I'm doing. I also want to say that I'm really trying to broaden my research into partnering with people who are, really engaging with retail investors, whether that's brokerages or, there's a lot of startups going into like ChatGPT based models, but for financial applications.
Yep.
And part of my research agenda going forward is partnering with these people to help them better understand who's using their product and how their product's being used, and then that'll also benefit me from the academic standpoint. And so if they're interested in that, they can reach out to me through my Colorado email address, austin.moss@colorado.edu.
Excellent. We need more people like you doing research on investing behavior of individual investors, and how, the service providers, this ecosystem helps, doesn't help them. I think it's a great cause. So Austin, thank you very much for joining me today. It was informative, and I think we all liked it. And thanks to you guys, as always, for watching us at home.